I'm Sarah Borgson-Keto, and in conjunction with Nareit's REIT Week 2021, I'm speaking today with Jason Fox, CEO of WP Carey. Jason, thanks for joining me today.
Of course. Thanks for having us back.
Recently, your investment volume has shown good momentum. What factors are driving that, and what sorts of investments are you focused on?
Yeah, our continued momentum is really driven by two main factors. First, our diversified approach. This gives us the ability to invest across property types in over two continents. And second, our cost of capital, which continues to support accretive growth, along with our ability to access various forms of capital to fund these deals. As I noted on our first quarter earnings call, the strong momentum we saw in the second half of 2020, it's continued into 2021. In fact, our pipeline is the strongest it's been in many years and continues to build. As a result, we recently raised the deal volume in our full year guidance, with the midpoint now at about 1.5 billion. And this is not a point in time moment. There are several factors that point to this higher level of deal volume as being sustainable. If you look back at the last number of years, there are some macro forces or really strategic events at WP Carey that are specific to note. We closed the CPA 17 merger at the end of 2018 and continued the process of winding down the investment management program after that, which led to improved cost of capital, resulting in strong deal volume in the second half of 2019. And then in March of 2020, we were really beginning to hit our stride, had a very sizable pipeline, comparable to what we have right now. And then of course, COVID hit and everything kind of reached a standstill. So what you're seeing now in 2021 is really just a combination of having a clear runway, free of the distractions from some of our prior strategic changes, and cost of capital that works really well. And on top of that, corporates are even more focused than ever on sale leasebacks as a means of freeing up capital. And as the market leader in sale leasebacks, this is clearly a favorable trend for us. And all this is reflected in our recent surge in deal volume and raised guidance. You also asked about the types of transactions we're pursuing. And one of the benefits of our diversified model is that it provides for a wider funnel. This is across property types, tenant industries, geographies, all to source new investments. Our core main focus remains warehouse and industrial assets, which represented about 3/4 of our 2020 deal volume and just over 2/3 during the first quarter, and currently makes up about half of our portfolio by ABR. And of course, industrial is a competitive area of the market, but it's remains a very deep and diverse sector, and we continue to find plenty of accretive opportunities. In the US, the manufacturing sector continues to gather strength, which supports increasing interest in sale leasebacks as a way to free up capital that can be redeployed into various companies' growth initiatives. And in Europe, we're the market leader in sale leasebacks, and our significantly lower cost of debt there results in spreads that are generally maybe 50 to 100 basis points wider than for comparable industrial assets in the US. We've also had recent success in acquiring top performing grocery stores in Europe. In general, I would say we prefer European retail, where the fundamentals are more favorable compared to the US. The US tends to be oversupplied with fewer barriers to new development and really significantly higher retail square footage per capita. There's also lots of competition chasing the same deals in the US, especially post-COVID, with the surge in demand for essential retail. So in Europe, we can source deals at more interesting cap rates and with better lease structures because there are really just fewer institutional buyers. As I mentioned earlier, we can generate better spreads given the lower cost to borrow.
The potential for higher inflation has received lots of attention from REIT investors in the media recently. How is WP Carey's portfolio positioned for an inflationary environment?
Yeah, in addition to accretive acquisitions, a meaningful contributor to our growth comes from the rent increases built into our leases. And we're all reading the headlines. The most recent inflation numbers showed a significant uptick and were higher than expected, with inflation accelerating really at its fastest pace since 2008. Now, we have one of the best positioned net lease portfolios for embedded rent growth, especially in an inflationary environment. I'll give you some of the details. 99% of our ABR is generated by leases with some form of built-in rent increase. 61% of ABR comes from leases tied to inflation, really higher than all of our net lease peers. So with sustained inflation, we're very well positioned for it to flow through as incremental rent growth. The majority of inflation-linked increases, representing about 38% of ABR, is based on uncapped CPI. And within that, the largest category is tied to US CPI. The other 23% of ABR tied to inflation, and leases with floors and or caps, which we refer to as CPI based. The average floor is about 1.5% on an annualized basis, and the average cap is approximately 3%. So with inflation, if our 3% caps kick in, we'd be achieving substantially higher same-store rent growth. And then lastly, about 35% of ABR is generated by leases with fixed rent increases, where the average increase is around 2% per year.
You've been active issuing debt and equity over the last year or so. How is your balance sheet positioned and how does that support your investment activity?
Yeah, our cost of debt has become increasingly more efficient in recent years. Most recently, we executed 2 bond issuances in the first quarter, one of which, or I should say both of which, were at our tightest spreads and lowest coupons to date, highlighting the continued strengthening of our credit profile. Specifically in Europe, we issued 9-year bonds with a coupon below 1%. In the US, we issued 12-year bonds with a coupon in the low 2s, so really attractive rates. Proceeds were used to refinance the majority of our near-term debt, with our next meaningful maturities now pushed out until 2024. I'm also pleased to say that a couple weeks ago, we were placed on positive outlook by Moody's, which reflects the positive trajectory of our business and balance sheet and gives us confidence that we'll continue to have access to accretively priced capital going forward. In Q1, we also raised equity through our ATM program, accretively funding our recent investment activity and modestly deleveraging compared to where we ended the fourth quarter. And we still have equity proceeds available through the equity forward we raised in 2020, which gives us lots of flexibility in how we fund our investment activity for the remainder of the year.
ESG is an area that has received growing interest from the investment community, especially the environmental aspect. For net lease, where the tenant is responsible for day-to-day operations of the property, this presents unique challenges. How is WP Carey approaching it?
So currently we're focused on 3 main areas. The first is information gathering. We recently launched an initiative to start gathering relevant data from our tenants, such as their energy usage. And this effort really has 2 key goals. One is to benchmark where we are today against which we can measure progress in reducing our environmental impact going forward. And then 2, to start reporting the key environmental, reporting to the key environmental rating agencies, such as GRESB and the CDP in particular. As you can imagine, the data requirements of the various environmental reporting systems, they're not small undertakings for a portfolio of our size. So much of our immediate focus is going to be on how we can employ technology and work with tenants to gather it. The second initiative is focused on reducing the environmental impact of our portfolio. And as you mentioned, net lease is a little different than other REIT sectors in that most assets are single tenant assets where the tenant is responsible for and really in control of the property. However, in projects where we can exercise influence, such as on build-to-suits, we have been making environmentally conscious decisions, and we're focused on increasing the number of green certified buildings in our portfolio, really through both acquiring new investments to meet this goal, but also undertaking projects within our existing portfolio, such as expansions or renovations, in a way that positively impacts the environment. Green bonds, this has been part of our goal as being a leader in ESG for the net lease sector. We want to be proactive on the green financing opportunities and really begin engaging with green-focused investors as that area, continues to grow as part of the capital markets. So we're moving forward on a number of initiatives that support our desire to be a good corporate citizen on the environmental front, and we're really excited to see the results.
Jason, thanks so much for your time.
Thank you, Sarah.
And for more news and information from REIT Week, be sure to visit NAREIT's website, REIT.com.